Hello and welcome to our next session. In this session, we're going to look at intangible assets under IAS 38. We'll think about what they are, when we can recognize them, when we can't recognize them, and then how we treat those intangible assets that we do recognize. So the first part of that was, what is an intangible asset? Well, an intangible asset is a type of non-current asset. So it will be up there with your non-current assets, but it's not tangible. I think of this as an intangible asset being something you can't touch. So we're thinking about things like patents, franchises, goodwill, those sorts of things that are assets to the business, but you can't physically touch them. They have no physical substance. So just like non-current assets are depreciated, intangible assets are amortized. Just think of that as depreciation of an intangible asset over its useful economic life. So examples that I've got here are brands, franchises, patents. Now there are some others that we'll consider as we go through, but those are some of the main ones. Now that we understand what an intangible asset is, the first thing I want to talk about is when to recognize an intangible asset. When can we bring it into the financial statements? What criteria does it need to meet? Well, the first thing it needs to be is identifiable. That means it needs to be separable. You need to be able to separate it out from other assets, and you need to have a legal right to it. So you need to be able to identify what the intangible asset is aside from other assets, and to establish that you have a legal right to it. Think back to the definition of an asset. You need to be able to control an asset. If there was no legal right to a brand, for example, well then you wouldn't control it. So that's the first criteria for an intangible asset. It needs to be identifiable, which is separable, and there needs to be a legal right to it. Tied to that, it needs to be controllable. I said that you could control it through the legal right to it, and that's back to our definition of an asset. It must be going to give you future economic benefit. Again, that's back to the definition of an asset. It must be going to give you future economic benefit, i.e. profit. And we must be able to get a reliable measure of it. So that's not always easy when it comes to intangible assets, but it's a requirement in order to recognize it. So those are important because if it doesn't meet those criteria, we cannot capitalize an intangible asset. They need to be identifiable, controllable, give future economic benefit, and we need to get a reliable measure of it. Now, the next thing we need to consider is research and development expenditure, because this is an example of an area that is crucial to the exam for intangible assets. Can we capitalize research and development expenditure? Because if you think about it, the expenditure in order to create a product, so development of a product, is identifiable, it's controllable, and it's going to lead to future economic benefit as long as the product can be sold. And we can get a reliable measure of it because we know what we've spent. So can we capitalize that expenditure as an asset? Well, there are certain criteria that have to be met. First of all, research. Research is always expensed. It cannot be capitalized as an intangible asset. So that's because it's pure research. It's not going to lead to a product. It's just researching whether the product might be demanded, for example, or whether it's feasible to actually create the product. So it's not actually leading to something. So it's not going to give future economic benefit and therefore must be expensed. So research expenditure, we separate out from development and we expense it. So we always expense research development. Development expenditure, and that's expenditure that is going to lead to a product, so it's actually developing a product, will be capitalized if, and it needs to meet all of these criteria, it is commercially viable. So that means, of course, it's going to lead to future economic benefit, one of our criteria. Again, overall profitability, future economic benefit. We must have the resources to complete the project, because obviously if you don't complete the project, you won't be selling the product and you won't get that future economic benefit we've mentioned. So all of those are tied up in getting the future economic benefit. We must be going to complete the project, it must be profitable, and the product at the end needs to be commercially viable. It needs to be a separate project, again, back to our identifiability of the actual product. And the expenditure needs to be identified, and that relates to the reliable measure of what we've actually spent. That shouldn't be a problem. It may be an issue just in separating out, if you've got several projects or products, which expenditure relates to which. But that shouldn't be a problem. So overall, it needs to be technically feasible to complete and create the product. So really those are all examples of ways to meet the recognition criteria of identifiable, controllable, future economic benefit and a reliable measure, just related to development expenditure. So it would need to meet all of these criteria to be capitalized as an intangible asset. So if it meets those criteria, rather than expensing the cost of development, we take it to the balance sheet as an asset. So all of that is tied up in getting future economic benefit and a reliable measure. Let's see if we can identify these differences. Have a go at illustration 1 for this session. Try it yourself before then working through the answer with me. In illustration 1, we're asked which of the following should be classified as development. So remember, we need to know this because pure research will be expensed, whereas development expenditure, so long as it meets our criteria, will be capitalized as an intangible asset. So we need to think for each of these, is it just research or is it development that will lead to a product? So number 1, Lion has spent 200,000 investigating whether a particular substance that is found in the Arctic Circle is resistant to heat. Well, that's not development, that's an investigation, so that's research, and that would be written off. 2, Hoey Limited has incurred 250,000 expenses in the course of making new material for ski equipment which will be more durable. Well, that sounds like development. Now, we don't know if it's going to be feasible, etc., but certainly it's not research, so that one will be development expenditure. And so long as it met our criteria, we would capitalise it. 3, Ryan Limited has found that a chemical compound, malorite, is harmful to the human body. Well, is that developing anything? It doesn't sound like it. So I'm going to say no, that's not development expenditure. And Lion Limited has incurred a further 300,000 using graphite, so that's our material from number 1, which was research, in creating prototypes of a new heat-resistant bodysuit for humans. So actually, they've now gone on. They had done some research to see if it's resistant to heat. Now they've found a use for it. That would be the development expenditure. So just be careful as to whether something is pure research or development. Research will always be expensed, whereas development, you can then go on and apply your criteria to see whether you're going to capitalize it. Now that we understand the recognition criteria for intangible assets, and we know the difference between research and development expenditure, there are just a couple of technicalities I want to point out before we move on. Number one, we start the capitalization of development expenditure when we become aware that the criteria have been met. Now, what I mean by that is that if you have been spending on the development, but the criteria weren't met up to a certain point, that we don't go back and capitalize once we realize that the criteria has been met. We only start capitalizing once we are aware that the criteria have been met. So we don't go back to previous expenditure that we think, well, we spent that previously on this product. We're going to now, instead of writing it off, capitalize it. That's not the case. You simply start capitalizing from the date that you were aware the criteria are met. And there's an exception. This is an exception to the expensing of research development. If you acquired a subsidiary that had research and development expenditure, we capitalize both the research and the development. So remember, usually we expense research costs. Well, if we buy it as part of a subsidiary, we capitalize it. It's just a little quirk, a little exception in the standard. Be aware of it, but it's not a big issue. Now, the next area I want to look at is the treatment for intangible assets. We know we recognize the asset if it meets the criteria, and we recognize it at cost. So if we bought it, we'll recognize it at the amount we paid for it. If it's development expenditure, we'll recognize it at the amount of expenditure we incurred. Now, once you've recognized it at cost, you can either use the cost model or revaluation. So cost model will be cost less amortization, which I'll talk about in a second, or under certain circumstances, you may revalue the intangible asset. Now, that's only if there is an active market for it. And there are some intangible assets where there will be an active market. For example, fishing rights or production quotas, those sorts of things. If there's an active market for them, you can use the revaluation model. More likely in the exam, we're going to have to capitalize and amortize our intangible asset. So remember I said that just to think of this as depreciation on an intangible asset. So we write it off straight line over the useful economic life or in line with sales. So if we do it in line with sales, that means we'll need to estimate what our total sales will be of the product or using that particular intangible asset, and then write it off in line with sales. And we'll look at an example of doing that shortly. Now, when I say write it off, I mean it goes to the profit and loss account. So we write it off to the profit and loss, and we review annually to make sure that the useful economic life is correct and we're doing it in the correct way. One last point on this is that we will start amortizing when production begins. The reason for amortization is to match up the development expenditure or the intangible asset with its usage. So when we start production and sales, well, that means that we're going to match up the asset with that use. So we start to write it off to the P&L when production begins. Lastly then, on amortization, what if we decide that our intangible asset has an indefinite life? Now, what I mean by this is you don't know the useful economic life. I don't mean an infinite life, it's going to last forever. I mean you simply don't know how long it's going to last. For example, if you were lucky enough to have enough money to buy Coca-Cola as a business, you would be able to capitalize their brand name. How long is the Coca-Cola brand going to last? Well, to me, you cannot tell. So that would be an intangible asset with an indefinite life. We don't know how long it's going to last. So there's no amortization on that. But what we do is we impairment test it each and every year just to make sure it's not overvalued on our statement of financial position. So that's an intangible asset with an indefinite life, which means we don't know what its useful economic life is. We can't therefore amortize it. But what we do is impairment test it each and every year. Okay, let's see if we can do this. We've got two illustrations focusing in on the treatment for intangible assets, both when we capitalize them and then how to go about amortizing them. So let's look at those. You might want to have a go at illustration 2 first of all, and then work through the answer with me before we move on to illustration 3. In illustration 2, we have a new product, fold-up bicycle, and we have forecasted what we have as expenses and revenues. So what we're going to do is we're going to show how the development costs should be treated if they do not qualify for capitalization, and then if they do qualify for capitalization. So we have revenue from other activities, revenue from fold-up bicycle, and remember these are forecasts, and then development costs. So if they are not going to qualify for capitalization, well, we'll simply write them off. So if we're going to expense it, we'll have the revenue from other activities, we'll have the revenue from the fold-up bicycle, the new product, and we'll simply write off the development costs in 2005. So that will give us a net profit or loss of 100 of a loss in 05, then 1200, 1500 and 1700. The key figure here being the total profit or loss over the term, which is 4,300. Now let's compare that to if we do qualify for capitalization, and you'll need to do a working here because I'm going to do this in line with sales. So I'm going to write off the development costs in line with sales. So what I'd like you to do is I'd like you to set up a little table and start with your capitalized expenditure. I'd like you to work out what the total projected sales from our new product, the fold-up bicycle, are. And then I'd like you to write off or calculate the amount of amortization for each year based on the sales in that year. So we need the total sales for the 3 years, and then you need to pro rata the amortization based on the sales per year. So pause the video now and see if you can do that. Hopefully then you have something like this. The total expected revenue is 2100. The revenue from fold-up bicycle in 06 is 500. So 500 out of the 2100 times the development expenditure of 600 that we're going to write off gives us 143. Doing the same for year 2, we have 600 times 700 over 2100. And for year 3, 600 times 900 over 2100. So that's how we're going to write this off. Now we need to see how that will affect our P&L if we capitalise the expenditure rather than just writing it off immediately. So see if you can do that now. Pause the video and adjust your P&L that we did last time. Instead of writing it off all at the start, use our amortization rates that we just worked out to write it off over the 3 years. Okay, so hopefully you have something like this. In 05, 06, 07 and 08, we have revenue from other activities as we had last time. Revenue from the fold-up bicycle as we had last time. But this time the development costs are capitalised and then amortised. The amortisation we said was 143, 200 and 257. Which means our profit and loss will be 500, 1057, 1300 and 1443. But do note that the total profit will be exactly the same. We're just writing the 600 off over the term, the useful economic life of the product, rather than all in the first year. So that's really what the theory is behind this. You capitalise the expenditure to match it up to the revenue that you generate through the amortization later on. Okay, so you should now understand how you go about amortizing the capitalised expenditure. What I want you to do is have a go at illustration 3. So it looks like this. There are 3 projects. You need to decide, number 1, are you going to capitalise them? And number 2, are you going to amortise them? So what I want you to do is show how that will be treated in the current period and discuss each project as to whether it's going to be capitalised or not. So pause the video now and have a go at that. Okay, so we have our 3 projects here in development, starting with project A. It is in development and testing has proved successful. Production has begun and some sales have been made to date. The costs have been reliably measured and the project looks likely to be profitable. All costs incurred so far meet the criteria. So looking at the figures, we can see that the total costs to the start of the year were 600. We've had more expenditure of 200 and the total anticipated revenue is 20,000. And we've started generating sales. So basically, Project A will meet the criteria for capitalisation. We're actually told that. So we capitalise all costs to date, since we knew that it would be successful, and the amortization we'll do based on sales during the period. So costs capitalised to date were 600, costs in the period 200, so that gives us total costs to be capitalised of 800. Amortization in the period will be the 800 times the prorated sales of 5,000 out of the expected 20,000. And the intangible asset carried forward will therefore be 600. So that's how we would deal with Project A. What about Project B then? Well, it is also in development. Testing has been successful. Costs are measured accurately and they expect to begin production next year. All costs so far meet the criteria. Now, that means that yes, we can capitalise it, but no, we can't yet amortise it because we haven't started production yet. So Project B meets the criteria, all costs capitalised but no production as yet, which means that no amortisation can occur yet. So total costs capitalised will be 500. We have more costs in the period of 600, which means total costs to be capitalised of 600, which gives us an intangible asset, but we can't yet amortise it. Lastly then, we have Project C, begun in the current period. There's been a feasibility study, but it was inconclusive. Well, look, we now know that that is research expenditure. So pure research will be written off. So all costs to date will go to the income statement and be written off. So we don't have any intangible asset for Project C. Look, that should show you, first of all, how to decide whether you're going to capitalise or not. Secondly, how to capitalise. And thirdly, how to go about amortising the intangible asset. Crucially, you can only start amortising once production has begun. Now that we know what an intangible asset is, what the recognition criteria are, and how to deal with research and development expenditure, and of course, how to amortise the asset, I just want to point out some things that we do capitalise and some things we don't. So these are specific rules in the standard that you will need to know and that could come up in an exam question to check whether you do know it or not. So we will capitalise purchased goodwill. We know that because when we do our group accounts, we bring in purchased goodwill as an asset. But we also know that we'll bring in purchased intangibles. So if we bought a brand, or we bought a franchise, or we bought a patent, we will capitalise those. We'll also capitalise purchased computer software, and we will capitalise expenditure that increases the economic benefit beyond that was originally expected. So if you, for example, had some development expenditure and you capitalised that development expenditure and you were amortising it over its useful economic life, if there was more development expenditure on that product that increased the economic benefit beyond what you thought you were going to get, well then you can capitalise that on top of what you had already. So the key here is that it needs to be something that enhances the asset, not just maintains it. It's similar to a normal non-current asset. If you add something to the asset, you'll capitalise it. But if you're just maintaining it, that isn't capitalised. So do be aware of that if you enhance an intangible asset, well then you can capitalise that expenditure within it. So we know we'll capitalise purchased goodwill, intangibles, computer software, and any expenditure that enhances an intangible asset to give us more future economic benefit. I lastly want to consider things that you don't capitalise. So things to look out for in the exam that are not capitalised. So number one, internally generated items such as internally generated goodwill. I've already said that if we purchase goodwill, we can capitalise that, but if we internally generate it, we can't. What I mean by that is you may over time as a business have built up customer relationships, even customer lists, or brand loyalty, all of which would count as goodwill, but we can't create an asset out of it because it's internally generated. If someone came along and bought our business, they could capitalise it because they had purchased the goodwill. but if we internally generated it ourselves, we can't. Another one of those is internally generated brands. Again, if you purchase a brand, you can capitalize it, but if it's internally generated, you can't. Customer lists, I've already mentioned, might form part of your goodwill, so we can't capitalize that. And newspaper mastheads is a specific example given in the standard of an internally generated intangible asset that cannot be capitalized. So all of those can't be capitalized, and the standard says we must expense all startup costs, training costs, and advertising costs. The key one in there is training. You can never capitalize training costs, even if you argue that the training costs were part of the asset to train people to use it. You cannot capitalize it on the basis that you cannot control people. They could leave the organization, so therefore it doesn't meet the definition of an asset. So note that one and look out for it. Training costs cannot be capitalized. So those are expensed as incurred and not capitalized. So those are just some things to look out for as specific things that can and cannot be capitalized. So do learn them and realize that that's where the examiner may well focus. That then was our session on IAS 38, looking at intangible assets. You should now know the recognition criteria, what to do with research and development expenditure, how to deal with an intangible asset over the years that you have it, and specific examples of things you can and cannot capitalize. This is a fundamental standard, so make sure that you know all of those aspects.